Can you hear me if I oh,
Check 1 2. Oh, good morning. Welcome, everyone, to this hearing of the Banking Committee. I'm going to call to order March 3rd, 2026. Look forward to hearing some testimony today. We have a relatively short list of speakers, so we should be out of here before it gets too hairy with the weather outside. But I'd like to start my co-chair from the great city of Stamford. Has elected to go remote today. I believe she's here with us. Madam Chair, would you like to say hello?
Yes, good morning, Mr. Chair, and good morning, everyone. Thank you for joining us. I had anticipated on being there in person today, and I was out the door, and someone called and told me about the weather that's forecasted for Hartford. So I elected to see you all online today, so virtually, I guess I should say. But welcome, and again, thank you for joining us. I look forward to the conversations. Thank you, Mr. Chair.
Thank you, Madam Chair. Yes, no, it's a good call. It was starting to snow when I was driving in just now, and it all works seamlessly. Anyway, we've got this thing down pat, I think, after several years. Um, I do not have the benefit. I can't see who's online, but is Senator Berthel with us?
Yes, good morning,
There
Mr.
he
Chair.
is.
Good morning, and thank you for recognizing me. I am remote as well. A little bit of weather, a little bit of a lot of things going on at the same time, and we know that this virtual aspect allows us to be in a lot of places at a different in the same place at what am I trying to say? You know what I'm trying to say? To be in a lot of places at the same time. So I will be bouncing on and off to go to those other meetings remotely as well, um, but thank you for being in the room, and hopefully we'll have a good hearing this morning.
Great. Thank you, Senator. Rep. Hoxha, would you like to say hi?
Sure, very briefly. Good morning, everyone. I'm looking forward to hearing from all nine of our scheduled testifiers, and this is always a productive committee, and looking forward to hearing from you all. Thank you.
Great. Thank you, Rep. With that, we're going to get started. First on our list this morning is Attorney Susan Williams, who's, I believe, is going to be joining us online. Is Attorney Williams there?
Yes.
Okay, there you are. Hi, Sue. Good to see
Good
you.
morning. Good morning.
Hey.
I'll just get right to it. So, good
Right
morning,
ahead.
Coach. Would you like me to begin?
Yes, go right ahead. Sorry.
Okay. Good morning, co-chairs, Representative Doucette, Senator Miller, ranking members, Representative Hoxha, Senator Berthel, and distinguished members of the Banking Committee. My name is Susan Williams, and I've been practicing consumer bankruptcy law for 35 years in Connecticut as well as Massachusetts. And I have been a member of the Consumer Bankruptcy Roundtable of Connecticut since its inception in 1996. We're grateful that Senate Bill 300 has been raised and completely agree with the purpose of the bill, as there is a need to protect from debt collection any part or balance of an account deemed a joint account in which the debtor has no equitable interest. For example, it is not uncommon in my bankruptcy practice to have a debtor come in to the office and they're on a joint account with an elderly parent to assist with their finances and not have any equitable interest in the account whatsoever for themselves. The account has been set up for convenience purposes, and now life happens, and the debtor is needing to file for bankruptcy for their own finances. And under the current status of the law in Connecticut, the entire joint bank account is exposed to judgment creditors or the bankruptcy trustee if a case were filed. And with people living longer today, this scenario of adult children having joint accounts with elderly parents is becoming increasingly commonplace. It's also very common for debtors to have accounts set up, joint accounts with their children, and all of the money be either the child's gift money or wages that were earned. And the debtor, again, has no equitable interest in this account, but it's exposed to the judgment creditor or the trustee in bankruptcy. I find myself telling these potential clients, with these bank accounts that they cannot file bankruptcy since they will risk losing the asset of their parent or their child to the creditor or to the Chapter 7 trustee. This is a very harsh and unjust result. And there are two harms here. The debtor is robbed from their fresh start in bankruptcy, and the parent or child whose money is exposed to the creditors not of their own making. My Massachusetts debtor don't have this issue. My practice is on the Massachusetts line. Massachusetts follows the majority view of the states, and that requires courts to determine ownership in the account. It's my Connecticut debtors that I worry about. So the purpose of this bill is absolutely needed to protect Connecticut consumers. However, Senate Bill 300 as raised creates a new exemption under the state bankruptcy exemptions and refers back to the Connecticut General Statute 36A 290, which is confusing since that is a very statute that allows judgment creditors access to the entire account. Perhaps rather than adding an exemption, there could be an amendment to the Connecticut General Statute 36A 290 to adopt the majority view, setting forth a mechanism such as a rebuttable presumption, allowing the courts to hear direct proof that the account was open for convenience or proof that the debtor has no equitable interest. We have submitted within the written testimony suggested language for an amendment to that statute. And we do have a great need to amend the bankruptcy exemptions in Connecticut, specifically the wild card exemption of $1,000 that has not been amended since its enactment in 1993. 33 years ago, we still have our debtors grappling with a $1,000 exemption. We have set forth some of that information within the written testimony. And I thank you for the opportunity to participate in this discussion.
Thank you, Sue. Yes, I was going to ask if you submitted written testimony. I don't see it. Is it under your name or is it, did you do it with, submit it with others?
We submitted, it's the Consumer Bankruptcy Roundtable of Connecticut,
Okay.
and we submitted that, and a number of us have signed off on that.
Right. Okay. I just did find it. It was listed under Dave Falvey. Good. A couple of questions I have just right off the bat. You spoke to the 36A 290 issue and perhaps creating a rebuttable presumption instead. Could you talk a little bit more about that and how we might do that? As we go forward here in the next few days, we're going to potentially entertain substitute language to this. So any suggestions you might be able to offer in that would be helpful.
Yes, and we did submit some language within that written testimony. And this would be just allowing the co-owner of the account the opportunity to establish the fact that the funds that are in the account are not any part of the debtor's money. It would be the co-holders.
We'll take a
We also
close
said
look at
for
that. And then the other thing I was going to ask you just to illustrate, and you got into a little bit, but wanted to give you an opportunity to maybe talk more and give us sort of a real life case scenario of how this works. If you've had one from your practice or otherwise, you spoke about family members, perhaps elderly parents and things like that, being joint holders of these accounts and how that would work in the context of a bankruptcy. If you could just tell us again, in a real world context, how that might work.
Yes. So again, it's increasingly common for adult children to have their elderly parents. They'll be on the bank account, the joint bank account with their elderly parents just to manage their finances. And now this adult child, the adult child runs into financial difficulties, job loss, sickness, whatever the case may be. No one ever plans to file for bankruptcy, but they end up exploring a bankruptcy option. And if they have a joint bank account with that elderly parent or that child, then we are not able to file for bankruptcy and protect that monies, unless we have a wild card exemption or something available to us. But many times that money gets exposed to the Chapter 7 trustee. And so then the debtor loses the opportunity to file for bankruptcy, because you might say, well, the simple result may be just to close that account or, take the money out. You can't do that because there are statutes in Connecticut with look back periods, 4 years. It would be 4 years before, the co-holder of that account would be safe, because the creditor has the ability to go back under a fraudulent conveyance to grab that, as does the Chapter 7 trustee. So it leaves debtors in financial, dire straits and not having the option to proceed with the bankruptcy.
Okay, thank you. That's helpful. And I do agree with you on the wild card. We've looked at that in the past, sort of on a tangential basis, but I will just say at the outset, as I've told a few people about this bill and about the exemptions in general, the cognizance of the banking committee is obviously all things in Title 36A having to do with bank accounts. And typically the way we have operated up here is that the Judiciary Committee would handle everything else in Title 52, which is where the homestead exemption is, the wild card exemption, and so forth. So I think those issues are best discussed probably over in the Judiciary Committee, and this one here, which kind of, I know bifurcates the whole issue, but certainly that's a discussion that I agree with you that we should have. Any questions for Attorney Williams? Representative Hoppe.
Oh, sorry.
Thank you, Mr. Chairman. Quick question. Does current law make any distinction between somebody that is on an account with their parent, but only has the ability to make deposits on that account and doesn't have the ability to withdraw money from that account? So, for example, a parent and a child have a joint account. The child can only make deposits to that account, can never withdraw money from that account ever since it was created. Do the courts right now distinguish between that sort of relationship to the account by the person in bankruptcy court? Is there sort of a difference in the eyes of the court between that sort of role and actually having full privileges on the account, meaning being able to withdraw, and I guess that's about it. Either withdraw or deposit on a bank account.
No, there is no distinction, and it's the harsh interpretation of that very statute that we're speaking of, and the Supreme Court decision of Carrillo from 1997 that specifically sets forth that these funds are available in their entirety because the debtor's name is on the account. And so there is no distinction there. There's no distinction there. And we did put in the materials, in the Carrillo decision, Justice Burden in his dissent, did set forth that this, in the hands of the Connecticut legislature and not the court. So they were really putting it back to the legislature to solve that, because the judges that are rendering these decisions don't like the result and they don't like the outcome, but this is a statute that they're dealing with. And bankruptcy Judge Manning, in a recent decision that she had in Connecticut Bankruptcy Court, said the same thing. It's a harsh result, but I think we need to look to the legislature to correct this.
Okay, thank you. I appreciate that. That's exactly what I was looking to clarify. Just a real quick follow-up to that. Is there a look back period for ownership on an account? So, for example, someone knows that their bankruptcy is imminent. They they close the account that they're on with their mother or father or whoever. and that individual, opens up a new account, or they even just take themselves off the old account, and the mother or father still remains on the old account with the same account number. Is there any look back to that, or is that seen sort of as a fraudulent activity of sorts in the eyes of the court as it stands right now?
There's a look back under the Connecticut General Statute of 4 years. And if you close out the bank, and there's a 2-year under the federal statute. So that is deemed, you don't need fraudulent intent. It's just the mere transfer of an asset out of your name for no consideration could be deemed fraudulent. And that allows or gives the trustee the authority to go back and clog that money into the estate, if you file for the debtor, and it exposes the family member's money.
Thank you for clarifying that
So you
as
have to wait
well.
4 years.
Okay, 4 years, right. And if I could just make a little comment, Mr. Chair. Yeah, I mean, it just seems like, at least to me, it seems like a no-brainer as far as just, approaching this issue, because, as many of us on this committee, as it's true for many of us on this committee, we've probably worked in the banking field in one way or another, and I've worked in retail banking for a little bit, and you would see situations sort of like this all the time, where there's no malicious, intent on the part of anyone, really. Like the speaker said, life sometimes just happens, right? And people are put in these situations that they have to explore filing for bankruptcy, and unfortunately, the co-owner of the account is, put into harm's way, even though they didn't necessarily do anything wrong. So I think I'm glad that there's, an appetite to address this sort of, little nuance in the law, in the current law. Thank you, Mr. Chair.
Thank you, Rep. Senator Berthel.
Thank you, Mr. Chair. Attorney Williams, thank you for your testimony before us today. I'm going to just kind of piggyback on some of the questions that Representative Hoxa asked. If there is and I understand the whole look back in the 4 years and what the statutes, the federal and the state statutes speak to. What if there is if there's an agreement that is in place between, let's say, a child and the parent regarding the administration of those bank accounts? Does the bankruptcy court look at that in any way? I mean, the trustee, if I understand it correctly, the trustee does have some leniency in terms of what they can allow and not allow, but I understand they need to follow the law as well. But you're saying, I see you shaking your head, you're saying there is no, even if there's I guess I'm thinking maybe something like a trust, but that's something legally very different. But if there's a signed document witnessed by an officer of the court, an attorney, whoever it is, that says the child is simply helping the parents with this account, and if the child ends up in bankruptcy, then that wouldn't be exposed. And I guess you're going to say, no, there's nothing that protects the parents and their assets at that point if that situation happens.
No, because they're bound by the construction of the Connecticut General Statute. And by placing that money in that account, they have the ownership interest.
All right, and that would hold true as well with even with like a power of attorney. That was the clause I was looking for. A power of attorney that's given to the child. It doesn't prevent the account from being exposed in this scenario.
No.
Okay. All right. Thank you, Mr. Chair. I appreciate your comments, and again, thanks for your testimony today.
Thank you.
Senator, any other questions for Attorney Williams? Seeing none. Thank you, Susan, for joining us. Next on our list.
Thank you all for your time. Appreciate it.
John Wilson from AARP. Morning, John. Welcome.
Good morning. Thank you. Thank you, Senator Miller, Representative Doucette, and members of the Banking Committee. My name is John Wilson, and I serve as the volunteer state president of AARP Connecticut. I also lead the AARP Connecticut Volunteer Fraud Watch Network team, which educates Connecticut residents about consumer fraud and how to avoid becoming victims. And I also volunteer with the National AARP Fraud Helpline, which receives 500 calls a day from victims of fraud. AARP is a nonpartisan organization with nearly 38 million members nationwide, including almost 550,000 in Connecticut. Fraud prevention is a core part of our mission and work. House Bill 5315 would establish a working group to study consumer fraud and evaluate protections against it, with findings reported to the Banking Committee. This initiative is timely and necessary. Criminals increasingly target older adults through gift cards, electronic payments, wire transfers, cryptocurrencies, and even gold. Most fraud goes unreported, and according to the Federal Trade Commission, fraud losses to older adults amounted to an estimated $81.5 billion with a B dollars in 2024. While fraud affects all ages, older victims often suffer severe financial loss, emotional trauma, and related health impacts. Strengthening state efforts to combat these crimes is essential. Common scams include fake check, romance, government or business imposter, family emergency imposter, and investment schemes. These schemes typically involve rapid, irreversible transfers of funds, making recovery difficult. Perpetrators often demand anonymous payment methods such as gift cards or cryptocurrency, pressuring victims to act urgently under false pretenses. As our team educates consumers and I speak with victims of fraud, it is apparent that all of us need to be constantly aware of the evolving methods criminals use to steal our money and the ways we can protect ourselves from them. This working group will collect this information and make it available to state legislators and law enforcement. AARP strongly supports establishing this working group. We would welcome the opportunity to participate and share the extensive research and data we have developed on fraud trends and prevention strategies. Thank you for allowing us to speak this morning.
Thank you, John. You got it. We'd love to have you participate. Thank you for that. I was going to ask, were you personally actively participating in the bill that we did 2 years ago? And in fact, I think it was initiated first 3 years ago and then was passed 2 years ago on elder or senior fraud protection.
No, I was not involved with that one.
Okay. So I was going to ask, in light of what we did there, and I think we had a good and pretty broad discussion there, and there was a lot that went into that bill over, like I said, over 2 years. Last year, we kind of focused on cryptocurrency and the law enforcement side of cryptocurrency fraud. What would you see as an issue or two that's sort of remaining or emerging that we haven't covered in those two that we should talk about in this working group or otherwise?
Two would be gift cards and cryptocurrency. Gift cards are very, very commonly used by criminals. And it's very difficult to get money back from someone who has lost money with gift cards. There are some indications that some states now have put signs up where gift cards are available, cautioning people that the gift cards may be used fraudulently. There are some companies that actually counsel their cashiers and other people to be careful if they're handing out gift cards. I stood in line behind somebody at CVS about a month ago, a husband and wife team. English was not their first language. And the clerk said, well, I can deduct I can use your ID, sir, for $2,000 of these gift cards, but I'm going to use your wife's ID for the other $2,000. And it was a real difficult thing for me to do, to stand there and say, do I get involved in this or do I not get involved in this? So this is a big deal. Cryptocurrency is another one. Cryptocurrency is becoming very, very common. We all read about it in the news every day. And it's something that we have trouble keeping up with. And I think something like the working group would be able to get involved in both of these with statements about what is and is not current, and pass that information along to law enforcement so that we can stop the criminals before they take any more of our money.
Okay, thank you. Any questions for John? Rep. Delnicki.
Good morning.
Good morning.
What do you, are you comfortable with the makeup of the committee that would actually be doing the work here? Or should other individuals also be included?
No, I looked at the makeup of that, and to me, it seems like it covers just about everything that we need to do. You've got a variety of people there, a variety of expertise. From my own viewpoint and AARP's, I think that looks adequate.
As a follow-up, or could there also be somebody from, say, the Connecticut State Police? Because I know they've done some tremendous work on crypto, and it almost begs to have them as part of this working group, because they could probably yield a lot of good information.
They certainly could, and there are very few. I think there are only 2 people within the state police that are involved in the fraud business. Certainly adding them to the committee would bring their expertise into it, and I think that would be valuable.
I think that's good food for thought on the ability and the obvious expertise that they could bring to this working group. It's a good thing to see that we're getting ahead of the problem as opposed to running from behind the problem. And I think that's where the Connecticut State Police could yield something there as an adjunct to actually improve the working group there. Otherwise, I think it looks pretty good, and I appreciate your testimony.
Thank you.
Thanks, Rep. Delnicki. Any other questions? Seeing none. Thank you, John.
Thank you.
Next on our list is Attorney Neil Crane, joining us online. Neil, you there?
Thank you, committee, for the opportunity to speak on behalf of Senate Bill 300 and on behalf of a group of Connecticut residents who each year face financial hardship. My name is Neil Crane. I've been a practicing consumer bankruptcy lawyer for 43 years, and I've worked throughout the state in the cause of representing single mothers, nurses, policemen, policewomen, firefighters, the disabled, elderly, and numerous honorable, hardworking individuals. I'd first like to thank this committee for expanding the homestead exemption through 52-352-21 that was passed in 2021. It's a great state law, and I can tell you that every day I see families whose homes are saved by this one law. Unfortunately, as has been mentioned, we have a number of other Connecticut laws that are just not assisting our Connecticut residents. These are laws that work specifically against Connecticut residents. They're Connecticut laws that prejudice Connecticut residents. And in my experience, this is not done in other states and in essence can prevent access to the bankruptcy system entirely. Our ask is not major, and we believe it's going to help thousands of Connecticut residents who are in financial difficulty each year. We're looking to correct the prejudicial mandate found in the wording of 36A 290. Our ask here is that bank accounts, our ask here is that you follow through on some of the requests of prior Supreme Court judges like Judge Berdun, and most recently Judge Manning, who recently was forced to take away the babysitting and birthday money of a son whose parents had filed bankruptcy. She acknowledged that this remedy was harsh, but clearly stated, as we have in our written testimony, that she was unable to make this equitable determination that the money did not belong to the debtor and instead belonged to the son because of this legislative wording as it presently stands. I realize that the wording of Senate Bill 300 may not be perfect at the moment. It may need work, and we're prepared to collaborate with the parties necessary to get this edited language precise and correct. But in specific, we want a state statute that does not prevent someone from asserting their rights to their property or prevent judges from making just and proper decisions that they make in other contexts on a continual basis. If you have money in a joint bank account or a bank account with someone else and that money is taken, it's gone. The case is closed. There's no avenue for recourse. The money is gone, whether it belonged to the Boy Scout troops, your grandmother, or your children's savings.
Your 3 minutes are up. Please wrap up your remarks.
Pardon me?
Can you please wrap up your remarks? Your 3 minutes are up.
I would like to give an example of a client of mine that I have right now. She's a single mother. She works in healthcare. Michaela, unbeknownst to her, her mother had elderly, widowed mother, had put her name on a bank account with $27,000. This was the insurance proceeds that her mother received when her father died. And because of this overly restrictive bill, her mother's money went to Michaela's creditors in full. Michaela was completely unaware that her name was on this account. But when she filed, there was nothing that anyone could do. As Judge Manning stated, she's been denied the opportunity to make this decision. Clearly, this money from her father's estate to her mother should not go to creditors. And this is a good example. This is occurring on a regular basis. This doesn't happen in New York. It doesn't happen in Rhode Island. It doesn't happen in Massachusetts. It just happens here because our Connecticut law does this to Connecticut residents.
Okay, thank you, Neil. I appreciate it. I appreciate you bringing this forward on behalf of the roundtable, and I really appreciate your written testimony with what seems to me at first glance a very sensible revision of 36A 290 in addition to, or perhaps in lieu of, what's actually in SB 300. So going to certainly take a close look at that. And I see also you mentioned, and I was going to ask, the case with the babysitting money. Is that the Farrell case that's referenced in your testimony from 2021?
That's correct.
Okay. And my only question about that is, I don't know if you're familiar with the facts in that case, if in fact that is what we were talking about, that it was a joint account for the minor and had a few $100s or a few $1,000s in it. It wasn't a case where there was, a parent, attempt to avoid liability or avoid creditors by establishing that account.
That's correct.
Okay. Is there a protection against that if a creditor were to say, this account was set up yesterday, or would we be looking at sort of the look back argument that we talked with Attorney Williams about, if that were to be an issue that is alleged by a creditor?
In fact, any transfer of money that doesn't even belong to the debtor to another account or that stays in the account with the joint party is subject to being clawed back under the bankruptcy provisions for a period of 4 years.
Right.
So that money would certainly be caught and brought back in. We understand the reason for clawbacks, but this is in essence not something that should be a clawback because it never belonged to the debtor in any fashion, other than the specific wording of the statute that needs to be changed.
Right. Okay. Thank you. Any other questions for Attorney Crane? And I lost my Zoom. I don't know if there are any hands online. No? Okay. Well, thank you, Attorney Crane. Appreciate your testimony today. Thank you for joining us. Next, going to go to Bruce Adams from the credit union.
I'm here.
Hi, Bruce.
Hello, Representative, and greetings from Washington, D.C., where I am doing federal advocacy this week, and apparently now also doing state advocacy this week. My name is Bruce Adams. I'm the president of Connecticut's credit unions, and I've submitted some testimony on a number of bills, but I want to focus my testimony this morning here, my oral testimony on Senate Bill 303. House Bill 5318 and 5316. Senate Bill 303 is similarly to 5318 forces each Connecticut credit union to provide card services, even if their members have chosen, their members being their directors, have chosen not to offer card services at all. So as a result, what may happen is that a small credit union would be forced to onboard a card issuing program, even though their members have expressly rejected such a product offering. So as this committee well knows, small credit unions in Connecticut sometimes make far less than, let's say, $50,000 on their bottom line profit. And onboarding a card service program can easily swamp that amount. So Senate Bill 303 is just untenable for us as credit unions. And similarly with 5318, requiring every financial institution in Connecticut to offer a campaign account just so that they're ready in case a candidate walks in the door is similarly untenable. And I'll refer you to my written testimony for further detail. House Bill 5316, on the other hand, by its very title, this bill is so obviously in need of passage and an enthusiastic endorsement by this legislature. In no way, shape, or form should real estate investments trusts be in the business of owning or controlling the people that cut us open, remove the problem, and stitch us closed. Real estate investment trusts are owned and governed by fiduciaries whose sole responsibility is to maximize profits for the investors. That runs counter to compassionate, quality medical care. It is simply not in the DNA of real estate investment trusts to keep providing facilities open when it is against their own financial interests. So for that just embarrassingly obvious reason, Connecticut's credit unions stand strongly in support of this bill and in support of the physical and financial well-being of their 1 million members in Connecticut. With that, I'll conclude my remarks and open up to any questions from the committee.
Thank you, Bruce. Yes, you really are multitasking today. Senator Miller has a question.
Thank you, Mr. Chair. And hello, Bruce. I'm glad to see you're feeling better.
Thank you, Senator.
Bruce, so going back to Senate Bill 303, do you know the intention of that bill?
The policy aims are very obvious, right? We need to expand access to affordable credit and help give people a pathway to financial independence. And credit unions, as you know, share that goal 1,000% as a policy matter. The challenge for us is that when you've got a credit union that is, 10, 12, 30, 50, under $100 million in size, many of them just don't have the human expertise or the money to offer cards at all. So forcing them to do so basically takes money out of the pocket of the very members of the credit union itself. And that's why we need to have at least a carve out for for any financial institution that does not offer cards, should not be forced to onboard a card program.
So can you provide a number of your members that do not provide cards?
I can give you that. I mean, I can't give you the data here in
No, not-
testimony right now, but yes.
No, but can you provide that, eventually provide that? And then do you also have an idea of what the onboarding cost would be?
Yeah, so excellent question. And really, and the bankers haven't testified yet, but I'm sure they will on this point too. Almost no, in fact, I think no financial institution in Connecticut does its own card issuing. That's all third-party vendors now. And so those costs can change depending on the size and complexity of the card program. But going to these large providers is expensive right out of the gate. There's coding that needs to happen with the financial institution's core processing system, much of which is custom coding. And so for a small credit union, it can clearly run to the tens to the high tens of thousands just to get off the ground. And I'll add a shade of context or detail to this. Should a large credit union or middle-sized bank, what have you, already have a card program, adding or changing different card options is still expensive, but it's not the same as going from 0 to 60.
Thank you, and thank you, Mr. Chair.
Thank you, Senator. Bruce, I had a question about 5318, the candidate committee
Yes.
counts. I don't know if in preparing your testimony, you kind of surveyed, or you could tell me about how many of your, member credit unions, have candidate committee accounts or have experience with candidate committee accounts. I realize it's a little bit of a niche market with, no more than 187 times 2 or so every 2 years, but or you could consider municipal candidate committees as well, but what their experience is with it. I mean, this bill seems very straightforward to me, and I mean, well, let me ask this first. You don't prohibit someone from establishing, or the credit unions don't prohibit someone from establishing a candidate committee account if they were to walk in the door today to one of your member credit unions. Is that correct?
That's correct. Yes.
Okay. So they're not going to turn them away.
No.
So then what is the burden that this bill would place exactly?
Right. So it's one thing if if a candidate walks into, let's say, Connecticut State Employees Credit Union or American Eagle, one of the larger ones that you see on TV. Those credit unions can be more nimble and adaptable to to a request of the sort that this bill gets at. And admittedly, that's where these candidates are likely going to go. To a place that has the service level that they need in order to run a campaign out of it. On the other hand, however, let's take New Haven Firefighters Credit Union, which is, I think, 5 million, just under or just over 5 million in size. And again, admittedly, a candidate is likely not going to walk in there to run their campaign, even if that person is a firefighter from New Haven, because they don't have the what this bill would have them do. But now, if this is passed into law, that credit union has to take time to be ready in case a New Haven firefighter wants to run for mayor and bring their account to that credit union, which may really not be able to handle the daily operational needs or burden of the candidate on a day-to-day basis. And that's really why we're standing in opposition. It's not for any reason other than helping our small credit unions avoid unnecessary operational burden.
Okay, thank you. Any other questions for Bruce? Rep. Delnicki.
Mr. Chair, if I could, before Rep. Delnicki, I just wanted to add, I think if the committee wanted to set an asset size threshold underneath which a financial institution doesn't have to do this, we would be open to an idea like that.
And what would be a good asset size threshold?
Sure, because I came very prepared for that question, and I did not just speak without thinking. I would suggest, I think 50 million and under sounds right to me, or 100 million and under. But 50 is probably safe.
Okay. Rip Delnicki.
Thank you, Mr. Chair, and thank you for coming out, Bruce, and talking about the private equity issues for hospitals. But I want to just have you put your thinking cap on for a minute here. Are we going to see the same thing happen on homes? Because the home stock seems to be going down on availability. And some of these firms are like BlackRock and quite a few others are actually buying up homes and then putting them on the rental market, precluding people from actually being able to buy the homes. Do you see anything like that happening on the credit union side?
As a representative of Connecticut's credit unions, the strict answer to your question is no. I'm not seeing from within the credit union industry large amounts of angst or complaints of the impact of private equity on our housing stock. That said, as a citizen of Connecticut and an observer of financial matters and business, I do see it, and we all see it. The other thing that we all should know, as well as we know the back of our own hand, is that private equity is not consumer friendly, period. It's just not. Private equity is designed to take whatever assets it owns, squeeze all the value out of it, and then move on to a new transaction and deliver that value to the shareholders. And so any effort on private equity to buy up concentrations of housing stock, which we saw during COVID, will necessarily provide an economic drain to the, and frankly, a social drain to those communities, because it will be corporate owned housing stock that will fall into disrepair, that will, do any number of things that we can pull from the history books on what private equity does. And at least at a minimum, within the residential community, you still have individual houses that people can move into and move out of and fix up and repair their own roof. You don't have the same thing with respect to a hospital here in Connecticut. It's a much more risky situation.
As a follow-up, should we be looking at that, and should we be regulating that in some fashion? Because I hear it from numerous people that want to buy a home and they find themselves in a situation where they can't. And it's a private equity concern. What's your thought on?
I mean, to some extent, this conversation goes back to whether corporations are people. So a real estate investment trust, a private equity organization, has the right to act in this world and to act in our American economy. And to some extent, that right shouldn't be diminished. On the other hand, as policymakers, as people who care about our hometowns, people who care about our small financial institutions, our community bank friends, our credit union partners, as people who care about being able to get their broken arm fixed up around the corner by doctors who have lived in this community for 20, 30 years, we do need to make policy decisions and craft our laws to build the kind of state and the kind of community that we want. And so I think there is a healthy tension, there's a healthy balance in the question you're asking, Representative. And at the end of the day, I think it is within the purview of this committee and this General Assembly to make sure that private equity and real estate investment trusts are appropriately hemmed in their powers, so that they do not unreasonably gather up too many distressed assets and leave the wreckage behind.
Well, I appreciate the answer, and I think you answered a question in the back of my head pertaining to that whole private equity and the way the housing market has become victimized by it. And what's the American dream? owning your own home. And that dream is fleeting away if the private equity firms take over. Thank you, Bruce.
Thank you, Representative.
Senator Miller again.
Thank you, Mr. Chair. Bruce, I want to go back to 5318. Did I hear you say that credit unions aren't equipped to do the things that that are outlined in the bill?
Well, yes, there is, and in my written testimony, which I did not discuss in my prepared remarks, I'll just pull from it if I can look at it here for a second. So, you know, if the credit union on this is 5318, correct?
Yes.
Yes. So the bill would require the credit union to essentially bear a burden of proof to determine whether the candidate presented the proper form, whether that form was, quote, properly stamped and received by SEEK, and whether the form was, quote, properly accompanied by, quote, satisfactory proof of a federal employer identification number. Some of those things are things financial institutions do, you know, in the regular course of business, and some of those things aren't. So that is our concern about the affirmative obligations placed upon the credit union in this case.
So if some of that language was tweaked, then what would prevent them from handling? I guess where I'm confused is, or need clarification, is the difference between opening up a personal account, a business account, and a candidate account.
Right.
Because,
excellent.
Go ahead. I'm sorry.
Oh, no, I'm sorry. Yes, it's an excellent question. And one thing that will, I think, inform your question and inform the committee is a number of credit unions don't even do business lending at all or business deposits for the same type of reason. They don't have the expertise in-house to assess the business as a depositor. And so they've chosen not to do it. And you know, the easy example, which I do not bring to this committee because it's a little overreaching, is, you know, Faith Tabernacle Baptist Church Credit Union has no business or interest in doing candidate accounts and doing business accounts and doing anything. They want to help the congregation with their, you know, more immediate financial needs and build a stronger community. And I don't know that they should be forced to be ready to handle a candidate account when they're, I think, under $1 or $2 million in size. But that's an unfair example because it's such an outlier. And as Representative Doucette said earlier on, the fact is when somebody comes in with a financial challenge or an opportunity to a credit union, 9 times out of 10, they sit down, they figure it out, and they do the business. And you've heard me testify on this 100 times before. And so, and I will freely admit that in you know, in this committee, that should a candidate arrive at a credit union with, you know, having done all their paperwork and they just want to open an account, the credit union is going to figure out a way to do it. I'm just hoping that we're not forcing our credit unions to react unreasonably, like on a dime, or that we're not forcing them to do a whole lot of prep work for a very unlikely event. But yes, again, I will circle back to the point of your question. A candidate walks in the door with, you know, with a check. The credit union is going to figure out how to take the check and serve the candidate.
Thank you for that, Bruce. And if I may, Mr. Chair, I just want to make a point. So a candidate shared their story with me, and they couldn't find a bank or a financial institution in their town to open their account, and they had to go to a neighboring town. And that makes no sense to me, not here in America in 2026. So that's why I support this bill. And I'm hoping that we can come to some type of agreement where we can actually bring it to the floor. Thank you.
I will, and Senator, I will be happy to amend my position to support your aims on that bill, because as we like to say about credit unions, we're financial first responders and we're financial problem solvers. So as I stand still fully prepared to defend our small credit unions against against, unnecessary burden. I absolutely, I'm shocked by the story that you've recounted, that a financial institution in this town would turn away such a depositor. It doesn't make sense. Um, uh, so, um, so I'm happy to work with you going forward. I'm happy to share my support as we go forward again. And I guess what I would do is perhaps ask that we set another, a similar asset size cap, just so the small ones have a little relief there.
Okay, well, I look forward to working with you. Thank you, Bruce.
Thank you.
Thank you, Madam Chair. And thank you, Bruce. Safe travels. We'll see you
Appreciate
soon.
it. Bye.
Up next is Attorney Timothy Pletter. Attorney Pletter, good to see you. Thanks for joining us.
Thank you very much. Good just after morning. I do echo the remarks of Attorney Williams and Attorney Crane. I don't want to be redundant and repeat what they've said. So I just want to highlight something that is related in connection with SB 300 and the need to amend so that joint bank accounts are not per se subject to creditors being removing funds through executions or bankruptcy trustees taking funds. Joint accounts tend to be the vehicle of banking for the most vulnerable Connecticut residents. People who don't have the ability to go open a trust, may not have an UTMA account, Uniform Gift to Minors Act. They go into an account, they say, I have an elderly parent and I want to be on their account, and they get a joint account. Or they have a child, a teenager, and they want to have an account with them. That's the account they get most often. And those people, if they should turn to a bankruptcy, expose those assets. And those are the people that I think we need to protect by amending the law, not through an exemption, but by amending the actual statute dealing with joint accounts. And I'd be happy to take any questions. I don't want to restate everything already said.
Sure, thank you. And I appreciate that. And certainly I appreciate all the folks we've heard from this morning and you all getting together as part of this roundtable. It's been very helpful, and I'm inclined to agree with you that we want to look at perhaps some revisions to this bill as it currently stands in light of what's been offered. Any questions? Senator Miller has a question.
Sorry. Yes, thank you. And thank you for joining us this morning. I have a question just for clarification. Are custodial accounts included in bankruptcy? Parental custodial accounts?
Potentially no, if they're done properly, and the person filing a bankruptcy is merely the custodian, then no. But a lot of my clients think they have a custodial account, and we have them bring in the paperwork, and in fact, they have a joint account because the bank they went to, it was just easier and quicker and simpler, and for their purposes, it was the same thing. So a strict custodial account, which would be like an UTMA account, is not subject to bankruptcy, but a joint account, which is far more common, is.
Okay, and what about beneficiary accounts? So, because a lot of times the statements may have the beneficiary's name on the account. So are those subject to bankruptcy or no?
Well, we're talking about as a joint account. So if it is not a joint
No, I
account,
get it. No, I get it.
that might be a
I'm just
separate
asking the
problem.
question.
The beneficiary might be a separate problem if the beneficiary is the person filing the bankruptcy. But strictly, the statute that we're talking about is dealing with joint accounts, which most accounts I see with more than one owner are a joint account.
Okay, no, I understand that. I know the definition of a joint account. I was just asking the question.
Yes.
Thank you, Mr. Chair.
Thank you, Madam Chair. Okay. Well, thank you, Attorney Pletter, for joining us.
Thank you.
Appreciate your input. Next on our list, John DiOrio. Welcome back, John.
First, I would like to offer strong support for raise bill number 5316. And I have a suggestion for you there that you consider. This committee in the past for other activities has basically written into law that certain practices are inherently unfair trade practices. This is one of them, with costs in the millions to taxpayers. This is an excellent piece of legislation. And Mr. Delnicki, I do have some feedback for you on the residential side. If you'd like to ask a question about that after I heard your question to Mr. Adams, it was an excellent question. And the answer is yes, there is a risk there, and I'm happy to lay it out for you if you'd like. On raised bill number 5317, honestly, this one I'm just a little bit confused. It repeals a portion of the general statutes that doesn't exist. And I think A and B are inherently contradictory with each other. It appears to me as though A is trying to limit this specific disclosure just to purchase transactions for some reason. But then in B refers to closings and mortgage loans transactions in general. And as Representative Doucette knows, there are many types of mortgages outside of a purchase loan. And I would suggest that especially with current climate challenges that we're facing and flooding that we've witnessed ourselves, I'm not sure there are any circumstances under which I wouldn't want a consumer to see this disclosure. Those are the only two bills I have comments on. I only submitted testimony on the mortgage loan bill just to point out the current definitions that already exist. It would seem to me that one of those would do the trick. I think a mortgage loan at the end of the day is a debt secured by a mortgage deed of trust on some sort of property, whether it be a commercial loan or a residential mortgage loan, or different questions. But at the end of the day, it's a debt instrument that's secured by a mortgage deed of trust, giving a security interest to the lender as collateral. And I think it's defined that way several times already. It's hard to imagine why we would need another. And that is all for my comments, unless Mr. Delnicki would like to discuss the investor risk that exists with residential property that's similar to the problems we're dealing with in 5317. 5316.
Thank you, John. And thank you for pointing that out. As you know, I think probably having watched our process, when we raise bills, there's then a rush to get them drafted so we can then have a hearing. And then the hearing becomes an opportunity to take a closer look at the language and clear up any inconsistencies. And you may have identified some here. So we will definitely take a look at that. The intent of this is to go to only the flood insurance disclosures, to touch only the flood insurance disclosures and the definitions therein, which appear, as you've identified, in different places in the statutes and were amended last year in a bill that was supposed to be sort of a comprehensive look at flood insurance. And this was just one part of it. And as I think you'll hear from the CBA, the bankers, this was something that they felt needed revision. But your point is well taken. We may need to take a closer look to make sure that we're not creating any other inconsistencies by doing this. So thank you. Any questions for John? No? No? Hold on, I lost my Zoom again, but I do not, any online, no. Okay. All right. Thank you, John.
Thank you very much.
There it is. Okay. And the aforementioned Connecticut Bankers Association, Tom Mangello and Eric Corey are next.
Once again, good afternoon, everyone. It's great to be here. Madam Chair, Mr. Chairman, members of the committee, ranking members Berthel and ranking member Hoxa. A few things to talk about today. Obviously, there's a number of items on the agenda. I'll cover three bills quickly. Senate Bill 302, 5317, and 5315, all on the agenda today. First one up has to do with certain approvals by the Banking Commissioner and Connecticut Bank applications. We had a great meeting with leadership a few weeks ago, I guess it was, talking about this issue. And the crux of this is that the FDIC recently made changes to their branch application process. I think as members of the committee will probably remember, in the dual banking system, we have two regulators. We've got our local prudential regulator, which is our Department of Banking, which has pretty close but a separate set of rules with regards to branching, especially with opening up new branches. And then we have the FDIC, our second state chartered prudential regulator, which covers insurance and obviously a significant amount of the regulatory oversight that our banks are subject to. So when the FDIC makes changes to things on their level, we like to try to align them as best as possible. So there's a minimum amount of dichotomy, if you will, of regulation that goes on. And it makes it easier to essentially run your bank, expand it, open up branches, things of that nature. And that's exactly what this bill does. It really syncs up what the FDIC has done with regards to making it easier for banks to essentially establish branches, new branches out there, and align our state rules and laws with that as well. It's a relatively simple change as far as that goes, but we think it's important. You know, in the past, it has gotten more difficult essentially to open up branches. That's particularly because of the FDIC rules that are out there. There's something called realistically expected market areas, things of that nature, which we disagree with. I think they're finally realizing that they are going to try to make it easier. And I think there's a lot of towns out there that would appreciate having bank branches located where they are. So this really just makes it easier and eliminates additional regulatory requirements, particularly with regards to the filing of a CRA plan for those banks that already have a satisfactory or an outstanding CRA rating. That's the simple version of what the bill does. We did submit written testimony on that, which goes into a little bit more detail for you. And be happy to answer any questions on that particular bill. Okay, seeing none, would you like me to move on to the next?
Yeah,
one?
go ahead, and we'll I'm sure if any questions come to us, they'll come to us.
Right, sounds good. Thank you. Okay, next up is the mortgage loan. I did hear this discussed by a few of the testifiers prior to us. And this is really just a clarification of last year's bill. And that was, let's see, last year's bill was Public Act 2533, which requires banks, insurance carriers, and real estate brokers at the appropriate time in the transaction cycle of a first mortgage, essentially to disclose that even if you're not in a flood zone, you can essentially still potentially get flood insurance. And that's obviously a consequence of the severe flooding and damage that we had experienced a couple of years ago, particularly in the Naugatuck River Valley. Obviously, we were okay with that bill. However, we thought it really just applied to first mortgages. So what we're asking is a clarification that this does apply to first mortgages. Just as a reminder to the committee members, we are already significantly active in this area. We're required to do that by the National Flood Insurance Protection Act, which every new purchase requires us to essentially do a flood determination on every single property. And if it is in a flood zone, we have to essentially make sure we follow the law and let the borrowers know that they have to have flood insurance to essentially consummate that mortgage. So simply a clarification as far as that goes. Questions, comments, or? Okay, I'll go to the last one. The working group to study consumer fraud and protections. I think it's a great bill whose time has come and ought to pass. We've struggled with fraud for years. However, on the other side of the equation, the banking industry, as I think you will find, has essentially gone a long way towards combating fraud. I mean, whether you're talking about chip-enabled cards, multi-factor authentication, AI-driven fraud detection, real-time alerts. I mean, all these things go a long way to protect. And that was basically because of the literally billions and billions of dollars that the banking industry as a whole has spent over the last decade to essentially make our financial system, quite frankly, one of the most secure in the world. And I think that all Americans recognize that, certainly the people, in the state of Connecticut, that Main Street banks are still one of the most trusted financial service providers out there. A recent American Bankers Association survey showed that 90% of customers and consumers out there are confident that their bank is taking proactive steps to protect them. With that said, unfortunately, the criminals are innovating and investing as well. During the pandemic, there was close to $300 billion stolen on a worldwide basis, and a lot of that money going to nation states which promote that type of activity, actually encourage it. And what's it resulted in? AI, obviously, deep fakes, spoofed calls, stolen IDs, fake checks, you name it, fake social media accounts targeting everybody on a nationwide basis. So while we've done a lot of work, we're proud of the work that we've done. There's still a lot of work left to be done. And to combat that, one of the things that we're going to be doing and announcing in the near-term future here, hopefully at the middle of this month, is a campaign on a statewide basis to all consumers, which we call Banks Never Ask That. It's already been out there. Several of our banks have done it on a smaller level to their local marketplace, and it's been very well received. So we think it's going to be a great informational program for people out there to recognize that banks do never ask a bunch of different questions out there. And if you're getting a question like that, don't even accept the call or have any communications with those folks. We're hoping we'll actually see some good tangible results on that within the next couple of months. Obviously, we look forward to working with the committee on the working group, which is proposed in House Bill 5315. We've got a number of concepts that we'd be happy to bring up for conversation on that. And I'd also like to mention that, as we work out there, we're not doing it in a vacuum. We have a bunch of partners with us on a local level. We're working with the state police. We're working with local police as well. On a national level, it's the FBI. It's the IC3 group, which can claw back lost dollars. The sooner you know about it, the quicker they can get those dollars back. And once again, I think the working group it's a great idea. It's a time who has come, and we'd be more than happy to participate in it. And that concludes my remarks. Be happy to answer any questions anybody may have.
Great. Thank you.
Just
Attorney
quickly,
Corr, you have something to add?
just quickly on a few other bills. Senate Bill 300, we're opposed to that. That's the joint account debt collection bill that I think you've heard a lot of testimony about. You'll hear some more from our colleague Bill Marone. But our concern there is it's going to put banks in between judgment debtors and judgment creditors and setting them up to make a determination as to who owns which funds in the account. Funds come in and out of accounts. It's impossible to tell. So that's our concern there. We've submitted written testimony about that. Secured credit cards, Senate Bill 303, like the credit unions, state charter banks in Connecticut don't have credit card operations. They partner with larger financial institutions that issue credit cards. And so, forcing state charter credit unions to create this program would be very difficult, or rather banks would be very difficult because they'd have to get those operations started, which are very complicated operations. Homes for CT, we love that program. We love this legislation. We're looking forward to continuing to work with the committee on the language for that program and standing that up and seeing that successful. And then 5318, we have concerns with candidate committee banking accounts. We've submitted written testimony on that as well. Thank you.
Okay. Thank you. You're hitting a lot of them. Almost, you're batting like 700 in terms of our agenda today, commenting on all of our bills. Appreciate that. Senator Miller.
Thank you, Mr. Chair. I want to ask Art a question first on 303, Senate Bill 303, Art. So, and by the way, hello, and thank you both for testifying. Did you say that your banks don't have, state charter banks don't have credit card operations, so they don't offer credit cards?
That's right, Senator. A long time ago, they would issue credit cards and they would have credit card operations, but that market space became very competitive, very costly to maintain. Small portfolios of credit cards. The competition from the large, national issuing credit card companies and banks made it very costly and very difficult to maintain those operations. They're very costly operations given the regulatory compliance requirements. It's a very unique, type of credit that has lots of very special consumer protection, including under the Truth in Lending Act requirements that really require you to have almost a separate department to manage a credit card portfolio. So the smaller banks, our state charter banks, have gotten out of this business and knowing that their customers would still like credit cards from a community bank, have partnered with large credit card issuing banks that will issue the credit card to the smaller bank's customer, but they'll put the logo, the brand on the credit card. So you're walking around with your, ABC state chartered community bank credit card. It's got your local bank's logo on it, but it is actually issued by one of the larger credit card issuing companies that the banks partner with. Looking at Representative Hoxa and Thomas and Savings Bank, not sure who they partner with, but I'm sure it's FIS or Capital One or some large issuing bank. So it allows banks to still provide that service without having to maintain that very complex, costly structure for what would be just a very few. And this would actually be a very small number of cards. We think that would require those operations to be established.
Okay, and so do you know the intentions of this piece of legislation?
I think it's to help consumers to build credit by using this, by having a credit card that is secured by a deposit. I think the theory is that the credit card issuer will be more likely to issue the credit card to somebody who is trying to build their credit, rebuild their credit, but because it removes some of the risk, having the deposits to back the debt, if you will. But there are, as our research has shown, that there are plenty of secure credit card programs available from fintechs or the larger banks. There are also many of our community banks offer not credit card programs, but small loan programs that are designed to help people build credit that are not. Some are secured, some are not secured. It's not a credit card, but it's just a small loan that somebody would take out and pay back and help them build their credit. So I think that was the intent of the bill. The difficulty with the state charter banks is while it's well intentioned and seems like a good idea, it would require very costly operations to be established by these banks to offer these credit cards.
Yeah, and
So thank you.
If I could just
I'm
add.
sorry. Oh, okay.
By the way, nice to see you as well. So when you take a look at the secured credit card program, it's typically looked at as a gateway to establish credit. That's what a lot of banks are still offering. We have banks that offer the secured credit card program. However, it's a product that needs to be maintained. It's a product that needs to be advertised for on your system, and there's obviously cost associated for that. There's a cost to add that product onto that. I think Bruce Adamson, the Credit Union League, was talking about that as well. So with that said, we have found there's a significant amount of competition for these cards out there. All you got to do is just Google it. And I think, as this committee knows, we're not a fan of mandates, if you will, especially when the product is easily available from a number of different providers, including some local banks here in the state of Connecticut as well, and easily findable on anybody's telephone, or I should say mobile phone, as far as that goes. But thank you for the question, Senator.
And thank you for your answers, Tom. So the two of you know that's why this is what I've been trying to do for the last couple of years, is to give individuals, the consumer, the opportunity to rebuild credit. And not only rebuild, but build credit. So I approached you first with the collateral loan account, and there was pushback on that. Now I'm coming to you with the secured credit card account, and there's pushback on that. So my question to you is, what do we do? Individuals deposit monies into an account, and let's take the collateral loan. There is no risk to that. I don't see, and explain that to me. I don't see the loss. I don't see the risk. If I'm giving you X number of dollars, and let's just choose $500, open a savings account, $500 in their account. I borrow against that account. You give me a loan against that account. I don't see the risk in that because you have the monies. If I fail to pay you, you have the monies, and we can make it a non-interest bearing account. But I really don't see the problem in having, let's say, the collateral loan account. I understand the secure credit card account, and you say it's going to cost, but I don't see the problem with the collateral loan. So because you push back on the collateral loan account, I came up with the secure credit card account. So help me understand, please.
Thank you for that. So when we're talking about a secured credit card, once again, it's a product that has to be offered, cost to it, compliance associated with it. Once again, another mandate, quite frankly, on state charter banks, because, you know, we believe it is preempted. The national banks would probably not have to do it. Although most of the larger institutions, which when you get to a certain size, do offer the secured card. So we're not opposed to the concept of a secured credit card. We think that's a good product. We're just concerned, and our membership is concerned about, once again, a mandate of having to offer that product, and only state chartered banks receive that mandate. With regards to a collateralized loan, per your suggestions last year, we actually did do a deep dive on what our member banks are offering out there, specifically from a commercial lending perspective for women and minority-owned loans out there and loan programs that are out there. And we did find significant numbers of banks that are actually doing really positive things out there for their communities and, you know, the population that you're trying to essentially serve. And we try to serve as well. So with that said, you know, we'd love to talk to you further about that. We think that we've got some really positive information. And we're certainly not opposed to having any type of a collateralized loan, as you indicated, because it is low risk. It builds credit. It's just a matter of essentially figuring out how to put it together, establishing it, and essentially marketing out there that would fit neatly into the CRA program. Small dollars, obviously, is what we're talking about. And but we certainly appreciate you bringing this forward and your concepts.
All right. Thank you. So I would like to have the conversation with you, Tom and Art, because we do need to do something to help the consumers of the state to build credit. We just heard from the bankruptcy attorneys, right? That people are filing bankruptcies, and home health aides, fires, teachers, firefighters, teachers. We need to do something to help the consumers. So the other question I had, Tom, is that you said that you would go into more details about the CRA, because I'm concerned with that as well. I'm concerned about that, that if we don't hold banks accountable to a certain standards, that the needs of the communities won't be met. So would you like to go into details about that as well?
Sure, absolutely. Thank you for the question. So when we're taking a look at banks that, once again, this is really triggered by the FDIC, which does not require that anymore. So when we take a look at the number of banks that are out there, and these are state chartered banks that we're talking about, federal banks have CRA as well, but this particular bill would only apply to state charter banks. So with regards to branching, putting together a CRA plan is expensive. And I think to your question, that the commissioner is not giving up anything with regards to his branch application approval process. They did take a look at this language, and they are okay with that language moving forward, recognizing, once again, it's a modernization of branching and will likely encourage banks to branch because it'll make it easier and less regulatory burden and cost associated with it. But with that said, the commissioner doesn't lose any of his oversight, his regulatory powers when reviewing a branch application process. it just makes it easier to essentially move through that process. And I hope I answered your question. And Art has a comment.
Just an additional comment, Senator. So the standard for the approval of a branch is, one of the criteria is that the commissioner has to make sure it's good for the community. And so that doesn't go away with this bill at all. He still has to review their community reinvestment performance. Every bank has a consumer Community Reinvestment Act performance report that happens on every 18 months or a couple years basis. So he still has to review those and make sure that the bank is meeting its obligations under the Community Reinvestment Act. This just would relieve those banks that are meeting the standards to not have to file a CRA plan for this specific branch. And as Tom said in his testimony, right now, there are 2 exemptions that apply to most banks. So it's actually not that much of a change. And to Tom's point, the commissioner maintains the obligation to look at this from a Community Reinvestment Act performance. And the commissioner can always ask for additional information regarding the bank's plans with regard to how to serve the community, which is still going to be part of the application. Actually, they have to describe how they're going to serve the community.
Thank you for the clarification. Thank you, Mr. Chair.
Thank you. Any other questions? I did have one just following up on what we were just talking about. The change we're talking about making in the branching 302 would basically apply to I think the majority of banks, in terms of if you looked at last year's CRA ratings, the majority of them, as I saw, were rated satisfactory. I would say, it's just off the top of my head, recalling what the list looked like, it looked like maybe, say, 75% of state chartered banks were rated satisfactory. A few were rated outstanding, and a few were rated needs to improve. But that 75%, if it is in fact 75% or thereabouts, would no longer have to file this extra report. Is that correct?
The needs to improve would still have to, if they have need.
Right,
Exactly.
the satisfactory.
Satisfactory and outstanding would not have to essentially do the report.
And for the most part, they're not now anyway. Even those banks under current law that are satisfactory, there's still a discretionary exemption available to them, that if they're satisfactory and they meet like 5 or 6 other criteria having nothing to do with CRA, then the commissioner can excuse them from that. So this would really just remove that discretion, which the commissioner said he was fine with, and would allow those satisfactory banks to be treated the same way as the outstanding banks.
Okay. And this plan that we're talking about submitting, what does it actually entail? What does it look like? How in depth does it have to be, specific to the branch? How lengthy is it?
Testing my memory as a lawyer, when I used to do these applications for banks, they're usually fairly brief. Not a lot of detail. Again, not often filed, because the law currently recognizes either the outstanding banks or the satisfactory banks with those additional criteria not having to file them. So they're usually focused on the particular community, with statements like, we plan to, increase competition by introducing another bank into this, our bank into this area. We're going to bring the following products and services to this community. That's kind of, it's pretty straightforward and simple.
However, they do need to be prepared to essentially back up anything that's out there with regards to their statements to the Department of Banking as to how are you going to do that. So there does need to be that background, which shows how you're going to deploy your assets out there throughout that new community that you're going to be serving with the branch.
Okay, thank you. Any other questions?
Thank you.
And once, going twice. Seeing none. Thank you, gentlemen.
Thanks, everyone.
Okay, and that brings us to our last speaker on the list today, Bill Marone. Hi, Bill. Welcome back.
Good afternoon. Co-Chair Doucette, Chair Miller, members of the committee. I'm Attorney Bill Marone. I'm a creditor's rights attorney, and I'm here to speak on Senate Bill 300. I came prepared to speak on an exemption claim bill, and that's where my written testimony was sort of directed. But as the day progressed, I think we may be talking about something different because it seemed like my friends on the bankruptcy bar, and I call them my friends because after the bill was raised, I actually called them and said, what are we trying to do here? Maybe there's space, let's talk. But what I hear is, I think both sides don't see this as an exemption bill in the post-judgment statutes. And I'll take any questions if I'm misstating how today has progressed, but that's how, in that chair, I heard everybody's testimony. And so it seems like they're looking to make modifications to 36A-290, which is the joint share accounts statute. One of the things that struck me, and it was in response to a question Co-Chair Doucette had to, I believe it was Neil Crane, was his 2021 case, which was referenced in his testimony. I didn't have the opportunity to review everybody's testimony because some of it published while I was here. So, but I did put eyes on that. But the one thing that struck me as interesting was you mentioned the 2021 decision. I have had the privilege of being before this committee for almost a decade now, and it brought me back to 2 sessions ago. If you remember, we did a bill, and I wasn't on it, but I know my friends from the banking committee and I believe the credit unions were in support of it. It was an elder care abuse bill where there was a handful of things. It was enacted in Public Act 23-161, and in that you made a change to 36A-290 subsection B. And in that subsection, you made a change from, let me see if I can find it on my phone. You made a change from a joint account under subsection A, which is the controlling section, in absence of fraud, undue influence, or a preponderance of the evidence to the contrary is prima facie evidence that the parties intended to open it as a joint and several liability account. Now that change is significant, and I'm a geeky lawyer, and you kind of educated me well. So I'm going to bore the committee on this one topic. The change was from clear and convincing evidence, which is the highest civil burden in the statutory framework, down to preponderance of the evidence, which is the same baseline standard for every civil case. So you guys, I think, and I wasn't prepared to speak on that specific section because the proposed bill, in no way, this was a bit of a turn on today's hearing, but I want to be responsive to what everybody else has said. I think you may have already done it. And the 21 case law may not have caught up to the 2023 change. And so I caution the committee wading into the waters too quickly, because as was said earlier, these usually, at least on the exemption side, emanate over in the Judiciary Committee. This one started well, maybe properly resides here if we're going to talk about 36A-290 and not an exemption statute. So I oppose 300 in the current format. I have caution on 300 based on what I've heard today, which is the case law just may not have caught up. You guys have made a change to subsection B, which may give what they are asking for. And I understand, I sit and watch every one of these hearings front to back, even when the bills aren't of interest to me. So they may not have known that it passed because it was a piece of a much larger legislation that was directed at elder abuse, at a community that is potentially abused or exposed community. So we may not need it, is all I'm saying. And let's keep the discussion if possible, if it's going to proceed. And that's it. The weather's bad. I don't want to keep anybody a minute longer than they need to, but I'm happy to answer any questions.
No, that's okay. Thank you. We appreciate you being here. And you got to go at last, so there were, you know, small chorus of three, the bankruptcy roundtable folks. I think it's good to hear your perspective as well. And that's a very interesting point that you raised. The preponderance of the evidence standard was done, you know, in the context, as you noted, of fraud being sort of the primary motivator for that change. I think, agree with you that it could apply in this case as, you know, addressing the question of, you know, the intent of the account holders and establishing that account. I guess I'd have to think about some more about how that would play out. But in terms of, okay, so I guess the question then would be, you oppose 300. I have your testimony on that. But I guess with respect to, and you may not have seen it yet, but I would point you to, it's been uploaded. It's under Attorney Crane's name. There is some proposed language, and that wouldn't be the statutory language, I don't think, but that would be what we were going for, which is slightly different than the preponderance of the evidence standard. It would clearly delineate that, and this, you know, it may be tricky, so I would appreciate your input on it either today or certainly after the fact, if you have a
I'm
chance
happy to speak off the
to
cuff
look
'cause I
at
never
it.
know what I'm talking
Right,
about.
but yeah, if after you look at it, you wanted to contact us. But that, you know, seeks to establish a standard where, you know, the assets deposited in that account or acquired by a non-debtor joint account holder for such holder's sole or predominant benefit. So again, the simplest thing, which I think is a good example, which was that 21 case, which I haven't read yet, but was represented to us as being about a minor's account, which is a joint bank account with the debtor parent or parents, with their babysitting money or whatever. So that's what we're trying to go for. So any thoughts on
I
that?
think it dovetails perfectly because I was very interested in Senator Miller's question to Attorney Pletter, because this is not totem trust or payable on death accounts. This is not minor accounts. So these are the generic joint accounts, the type of account that if my wife and I have it and I want to go to Mohegan Sun and blow it, she has no recourse. It is, I own the account. So when you say that it's difficult, I see the difficulty because it's almost like we're trying to parse and put a sub account in that category, if I hear it. Now, the reason I think the preponderance or the evidence standard is really important is, you know, the Carrillo, which is the seminal case that goes back to 1997, says, hey, you can go to Mohegan Sun, you own the account. But this carve out, which I don't see it used very frequently, and I could not, at least while I was sitting in the chair, find anything since its change in 2023. I don't know if it's been presented to the court, right? I mean, conceivably, it has made an alteration to both the prior statute. Well, it definitely has made an alteration to the prior statute, but the prior case law, because this legislature has spoken in a potentially different direction about the standard and path necessary. So if we're saying we need clarifying language to give a process for a party, I mean, I think the idea that you start with the presumption that everybody owns it and a joint account holder, and I think this is important. The bill is currently structured, I don't think is directed to the joint account holder. I think it's the judgment debtor currently under the exemption bill that gets the protection. So I think as it's currently written, we're in a position where we may be protecting the wrong party. So that's something that I think really needs consideration. I don't know if I'm responsive. I ramble, sorry. But it just shows that if we're gonna pull the thread, I think we need to do so in a very careful way so that we're not either over or under including people. And I wasn't prepared on 36A-290, but as I sat there, it jumped to me. I was like, didn't we just change that? And we did just change it. And I don't see if the case law has caught up to it yet. So my friends on the bankruptcy bar may not have had an actual fact pattern to test the new version, is all
Yep.
I say.
No, it's a good point. It's a good point. And it's tricky. And we're trying to do it on the fly. So but yeah, like I said, if you want to follow up with us afterwards.
Absolutely, I'd be happy to.
Uh,
And I always appreciate the committee's willingness to engage. I know that, you have a lot of input from a lot of sources and have always been willing to hear from us, and we really appreciate that.
Good. All right. Any other questions for Attorney Maroon? No. Okay. Seeing none, thank you.
Thank you.
Appreciate you joining us. Okay, so that brings us to the end of our speaker list, unless I missed anybody or anything. I'm going to go ahead and adjourn this public hearing. Thanks, everyone, for joining us today. We'll see you soon.
Thank you, everyone. And thank you, Mr. Chair.
Thank you. Bye-bye.
Great.